When looking for great investments, we usually face a tough choice. Do you bet on a strong company or a booming industry? With Trip.com, you don't have to pick. Trip.com offers a rare combination of company specific alpha and a powerful industry beta, but the market still hasn't fully priced that in, which makes it an ideal investment target. So today, I'm here with my teammates to present our strong buy thesis on Trip.com Group with a target price of 502.2 Hong Kong dollars, a 20% upside.
Thank you, Sandy. First is business overview. Trip.com Group is an online travel agent, built a bridge between hotels, airlines, and travelers. Every booking made through the platform, Trip.com takes a commission. Its perfect business model helps strengthen its moat and broaden its business in China and global. Trip.com Group is an absolute leading position in China's OTA market and has established the 4 core brands to dominate the Chinese OTA market and broaden its international presence. Its cost expense include cost of service, R&D expense for AI, and sales expense for market expansion. Its profitability is very good, outperforming most of the Chinese OTA peers. And next is the industry overview. China's domestic market has maintained a strong post-pandemic recovery momentum. In 2025, domestic arrivals hit 6.5 billion, recovering to 109% of the pre-pandemic level. Also, in major holidays in 2025, arrivals hit 2 billion, surpassing 40% of the pre-pandemic level. Also, with the online penetration rate steadily rising and visa facilitation policies favoring inbound tourism, these factors present promising opportunities. And next is the international side. China's outbound tourism has a 15% YY growth in 2025. Its outbound tourism penetration rate is only 10%, which is far lower than that of the US, Japan, and South Korea. We think in the long run, with the development of China's society, economy, and culture, there's great potential for higher penetration rate of outbound tourism. The global market has carried out 5.2%, but the Asian penetration rate of OTA is really low, which indicates enormous potential.
Thank you, Eric. Next is our investment thesis. For China market, Trip.com has built a truly dominant position in China's OTA market. In 2024, it holds the largest market share by wide margin, with around half of all the OTA bookings going through Tcom. On the traffic side, it owns over 100 million active users. These users are high-spending, young travelers, making Tcom the strongest monetization potential per user among all the OTA players. Tcom boasts the most comprehensive tourism resources. For transportation ticketing, it cooperates with over 480 airlines, gaining over 50% of domestic share. Along with the full coverage of railway, it builds its edge. For corporate travel, as industry leader, it holds around 9% of market share. Tcom secures stable partnership with unique strength, driving steady cash flow and travel traffic for the company. Turning to the hotel industry, China's hotel supply keeps expanding and is expected to grow steadily in the coming years. But demand isn't growing as fast, so the industry is moving into oversupply. We see this in India. After a peak in 2023, room rates dropped in 2024, and hotels cut price to compete. In this environment, OTA platforms like Tcom become increasingly important. If we look more closely, we see the growth of hotel supply is mainly coming from the top hotel groups. Brand penetration has risen from single digits to almost 30%, and the market share of leading chains keep expanding while independents shrink. Tcom is directly tied to this trend. It owns equity stake in Ashworld, BTG, and A2, giving it privileged access to the hotel inventory that is gaining its share and strengthening its advantage.
Thanks, Richard. Now for the third thesis. The company's international business. Geographically, it uses outbound tour to enter APAC, building ticket offerings, win local users, then expand globally. About growth, the fly hotel bundles Skyscanner-driven traffic, turning Tcom into a one-stop travel hub. Let's move to the results. First, the cross-sell ratio and app reservation is strong. Financially, the latest earnings call reveals that the trip has grown 58% and the MAU has grown 7 times in 5 years. Hong Kong and Singapore are profitable, with Trip contributing 30% to its total revenue. All this backs its international business as the company's second growth curve. Now for the fourth thesis, the AI investment. As the first OTA investment in AI, it can be applied in 3 areas. First, cost cutting. The AI customer services can cut the labor cost by 20% and shorten the training cycle. Second, efficiency. The AI recommendation can promote the ROI by 30%, and this newly travel agent can further boost traffic conversion.
Thanks, Vincent. And here's our financial analysis. This slide shows T-Com's improving balance sheet. Total asset grow at a CAGR of 7%, while debt-to-asset ratio declines to 35%. Cash now accounts for about 17% of total assets, indicating lower leverage and strong liquidity. For profitability, T-Com's profit margin is significantly higher than most peers and keeps rising. Due to the significant differences in capital structure among companies, we believe that ROA is more suitable than ROE for comparing. T-Com's ROA stays relatively stable during the whole period, indicating a solid and improving level of overall profitability. From liquidity side, current and cover ratio are among the strongest here, showing a solid ability to meet short-term obligations. Healthy OCF and rising cash reserves enable the company to repay debt and reduce reliance on external financing. As for cost control, expenses are well contained, while the relatively high R&D ratio is due to prudent AI investments, which are aimed at future cost reduction and efficiency improvement. T-Com also enjoys long payable days and short receivable days, so this time gap effectively provides cost-free financing. And here comes to our core part, valuation. We value T-Com using the 50-50 blended approach of DCF and multiple valuation that arrive at a share price of 502 Hong Kong dollar to both capture its intrinsic value and benchmarks against peer companies. Our core outcome is our DCF model shows a 21% upside for the stock. We split T-Com businesses into 4 segments: hotel, transportation, and others. For hotel and transportation, we use a price, volume, commission rate framework with region-specific assumptions. In hotel, T-Com faces distinct domestic and overseas competition. Domestically, as a leader, its room night growth tracks the industry. ADR is expected to fall amid fierce competition. Commission rate will fall in the short term, but we believe in the long term, T-Com can get premium due to comprehensive product metrics. Overseas, as a challenger, volume growth relies on expansion assumptions with stable commission rate and prices. Transportation was divided into 4 subsegments: domestic air, domestic ground, outbound air, and pure overseas. Ticket volume will rise short-term with tourism recovery and slow in long-term. Ticket prices and take rates will see different trends by subsegments. And for other businesses, we make assumptions directly on its growth. Meanwhile, incorporating a WACC of 8.53% and a terminal growth rate of 2%, we arrive at a target price of about 560 Hong Kong dollar, implying about 21% upside. We also stress test our DCF valuation using different methods. We run a sensitivity analysis on WACC and terminal growth and a monoclonal simulation, both of which point to a central price of about 506 Hong Kong dollar. We also run a scenario test with about 584 Hong Kong dollar in the bull case and 344 Hong Kong dollar in the bear case. As for the relative valuation part, by using a PE of 18.8 times and EV/EBITDA of 15.6 times, we arrive at a target price of about 494 Hong Kong dollar, implying about 19% upside that support our buy recommendation.
Thank you, Shirley. Now let's move on to ESG performance and key risk. In terms of overall ESG, T-Com demonstrates strong performance and commitment. It holds an MSCI ESG ranking of A and leads in the industry of Bloomberg's ESG assessment with a score of 3.93. T-Com's strong ESG performance directly supports our financial and valuation outlook. The increase in ESG rank boosts investors' confidence, supporting higher PE and EV/EBITDA multiples on valuation. Moving on to the environmental side, T-Com is the first in the industry to join the Science-Based Target initiatives, guiding a low-carbon transition. It also promotes sustainable level. Currently, 43% of its listed hotels are certified as environmentally friendly. Moving on to the social side, T-Com contributes to rural revitalization by creating over 500 direct and 40,000 indirect jobs locally. It also creates diversity by ensuring that 57.1% of its employees are women and actively employ people with disabilities and ethnic minorities. In customer service, it maintains 80% overall satisfaction and a 94% NPS for domestic hotels. Moving on to corporate governance, T-Com supports 62.5% independent, ensuring professional and unbiased decision-making. It also implements ethic training and a dual-track performance system, aligning employee incentives with long-term company goals. Now, moving on to risk, we have identified 3 key downside risks to our buy recommendation, which are listed on top of our slide, and we have also qualified these other risks in our risk matrix, ranging in impact from negative 29.6% to negative 23.4% on valuation. So, to conclude our presentation, we have presented a comprehensive analysis of Trip.com Group, and we restate our strong buy recommendation for Trip.com Group. Thank you.
Uh, on relative valuation, you mentioned price earnings of 18.8 is the relative valuation on the basis. So what is the price earning stock is trading today? And are there any structural risks that you are missing because in your analysis?
Its current price today is around 400 Hong Kong dollars.
Price earning multiple. What is the price earning multiple now? PE multiple.
Its current PE multiple.
Yeah.
Its current PE multiple is around like 10 times because we think that the consensus didn't downgrade its revenue projection and also the net profit projection due to the geopolitics risks and also the regulatory influences. And according to our revenue projection in 2026, it's around 15 to 16 times of its PE multiple. Thank you.
So what are the risks that market is incorporating, and maybe your thesis is ignoring that? It's trading at 10. You're saying the market relative P is 18.8, right? Why is it trading at such a discount?
We think that the market is just buying the regulatory influence, and the market is now some pessimistic about the regulatory influence on its long-term revenue growth because it didn't know whether the company's competitive mode can hold in the long term. But in our analysis, we think that in the long term, the company's market share will be influenced in the short term, but in the long term, it will recover. So that's our difference from our opinion with the current market.
Yeah, can you talk a bit more about, the regulatory anti-monopoly probe? Because, that's always been one of the risks for these type of OTA platforms. So, what's your view going forward and the impact for TCOM?
Okay, thank you for your question, and please shift. Yeah. We think that the anti-monopoly regulatory policy it is more of a short-term shock on T-Com's financial performance, but in the long term, we believe it will recover. The regulatory policy results in two negative impacts: the near-term fine and the decrease in bargaining power. For the cash fine, as the slide shows, that we reviewed the past cases and estimated T-Com's potential fine exposure. And given its solid cash reserve and operating cash flow, we expect little to none change to its operating efficiency or its intrinsic equity value. And next slide, please. And for the decrease in the bargaining power, especially T-Com's high-end hotel resources, in the short term, we will witness competitors like Alibaba, Meituan, and TikTok using subsidies to attract consumers. This will cause the decrease in T-Com's both hotel GMV and the commission rate, so reducing its financial performance. But in the long term, next page, please. But in the long term, we believe that the subsidy policy won't last so long, and the OTA platforms will turn back to competing service and product. We believe that TCOM holds the most comprehensive product metrics and ecosystem, so the share of TCOM in the long term will recover. And that's why it would make our opinion different from the market. And not to mention that the regulatory policy only affects TCOM's domestic business, a hotel business, but its international presence is not affected. So with its strong overseas expansion, we think that it has strengthened its resilience of its future financial performance. Thank you.
So, in terms of competition and its future growth, how much of its future growth comes from China versus other markets? And in terms of the other markets that you think it's going to get a lot of growth from, who's already competing there and how are they going to compete against them?
Okay, thank you for your question. We believe that the domestic growth TCOM will face a short-term shock due to the regulatory policy, but in the long term, it will recover moderately. And its future revenue growth mainly come from the overseas market, especially in the APAC markets such as Korea, Singapore, Thailand, and Malaysia, since TCOM is gaining market share rapidly from these companies. And also, my teammate will make some compliments about the competitors in these overseas markets.
And for the overseas market, please turn to the 3.5. Thank you. Firstly, we believe that there was a large ocean market. You can see that the online penetration in APAC is most
higher than China. And for TCOM itself, we can see that from the company guidance, they have a very clear and logical strategy, which means the fly hotel bundles. I can explain it to you that they send coupons and put advertisement to to appeal customers to buy cheap air tickets. And just after the customer finish their buying, the application will recommend the nearby hotel just after they finish their purchase, and it is very likely for the customer to book the hotel eventually, to book the hotel conveniently. So we think uses the strategy, and you can see in our search thesis there is some tangible results. So we think it is very high possibility for TCOMs to do its international business. Thank you.
And their competitors are mainly Expedia, Bookings, and their core market is not realizing in the APAC regions. So we think that with the strengths my teammates just mentioned before, we believe that there's no burden in the overseas market expansion for TCOM in the short term, nor in the medium to long term. Thank you.
I think in your sorry, thank you for the very good presentation. In the key risks you listed to your valuation, in terms of how they affect the value, they more or less wipe out the upside you have. I think the bulk of them have a almost negative 20% downside risk to the valuation. So I was just wondering what the key mitigations are and whether you would still recommend a buy recommendation given the extent of the downside to the risks.
You mean all the three risks or just only the geopolitical risks?
I think you listed three key risks to the valuation you have. Yeah. All of
The
them.
downside, the percentage of our downside is mainly of our target price. But compared to the current price, we believe there's only a 10% to 15% downside risk. And so compared to our buy thesis of 20% in base case and 40% in the bull case, so we believe that we will still hold a strong buy recommendation for TCOM. And these risks, we think the company and also the industry all have some methods to offset the risks. And I think the geopolitical risk, the downside won't actually happen and influence a lot about the company's stock price. The downside risk. Thank you.
Can you talk a bit about the impact of AI agents? Because Google, Perplexity, and so on, they all have agents like routing the booking to, OTA with the highest rebate. So how can TCOM defend this AI change?
Okay, first the company is clearly states that they will not develop the foundation model like OpenAI, and they will also not investment the data center capex expansion like Amazon. Instead, they uses the best available model and to tune it with their unique user data like some travel data, booking data, user preference, and the inventory. So turn to the difference between the chatbot of the and the agent of TCOM. We think that the chatbot can give you the travel plan, but the TCOM's uniqueness is lies in the very comprehensive inventory in the whole supply chain, and the capability to the fulfillment when you maybe when you arrive at the hotel and you find there were no hotel rooms left. And if TCOM's agent gets the permission, it can directly book the hotel for you. That is what I think is very different from the chatbot like ChatGPT and Gemini. Thank you.
And also to make some compliments about the AI to the industry influence, we want to say that for the consumer confidence, it is not a short-term effort for them to trust the AI agent to book the travel for them. So we think that the OTA industry won't be influenced in the short term. Yeah, thank you.
Given the fact that the bulk of their revenues comes from foreign denominated currencies, how have you factored that into your forecasts going forward in terms of FX risk for the company?
Okay, so thank you for your question. And we refer to the historical financial performance when we can see the TCOM just use the contracts that relies in the US dollar, US dollar based contracts, and for them they also use some they also use some methods to offset the volatility of the exchange. So we think that, and also to the historical financial performance, we can see that there is not a very huge amount of the exchange loss in the company's financial performance. So we believe that the company has the capability to manage the exchange rates changes in the future. Thank you.
Have you seen any impact yet of consumer slowdown in spending given the volatility and the geopolitical risk and that's been cropping up lately?
Uh, yes, we analyzed about the geopolitical. Next slide, please. And we can see from this slide, so many investors are worrying about the geopolitical risk in the oil prices and may think about the travel demand will be dampened. But we believe that, so firstly, the airline companies can use some fuel surcharges to offset the rising oil prices so that they can transfer the oil cost to the consumers. And second, we believe that travel demand doesn't disappear; it just redirects. When one region just faces geopolitical risks and travelers don't stop traveling, they will shift to safer destinations. In the Northeast Asia, Southeast Asia, and domestic China can absorb the redirected demand. And TCOM is now core business is in the APAC regions, and we believe these regions can benefit from the current Middle East situation if travelers avoid traveling to there. Thank you.
What do you think is the next catalyst for the stock to re-rate?
We think there are two potential catalysts. So for the current market, many investors are worrying about the regulatory policies and also some uncertainty like the geopolitical risks and also the myth of the company's overseas expansion. And we think the first catalyst is the company's future financial performance, maybe in the 26 H1 or in the financial year 2026. And we can see if the company's overseas revenue beats the market, and the investors will believe the company can make real expansion in the overseas markets. So its valuation multiple may rise, and the stock price will also rise. And second is we think if the anti-monopoly regulatory policy once set down, it will just eliminate the concerns of the market investors. So we think that if the regulatory policy just find TCOM, it will be a good buy point and for the future stock rising. Thank you.
And I also want to make some compliments. Please turn to 2.3. We see that the outbound and inbound tourism in China shows a great trend after the pandemic. And the 2025 sees a YY growth of 15%. And also with the relaxation and recovery of transportation capacity, the supply is recovering soon. And also with the visa facilitation policies favor these foreigners to go into China to tourists. So we think that inbound and outbound tourism also see a significant growth potential in the next year, in the recent years.
Judges, we can go ahead and make your any clear up.
Yeah, can you talk a bit more about the risk side in terms of the geopolitical risk? Because it can either be positive or negative. But then it seems that the visa renewals for Chinese tourists has lagged post-COVID, and the RMB also it's has been volatile and hitting outbound spending. So yeah, what do you think is the biggest reason, and how would TCOM you think TCOM will address that?